All right, I think we should get started. Yeah. Hi, everyone, and welcome. My name is Lori Donaldson. I'm the CEO and co-founder of Current Marketing Solutions. Today, I'm going to be your webinar host and interviewer. I appreciate your attendance, and I hope you find today's content valuable. We're excited you're joining us today for the very important topic of AI and acquisition, a conversation about leveraging AI to acquire new households and expand relationships with your existing ones. And today joining me is James Hansen, the COO and co-founder of Current Marketing Solutions. James brings decades of experience in financial services marketing for community banks, credit unions, and mortgage banks. His data-driven approach helps financial institutions to enhance their marketing strategies and drive growth. James has also led initiatives that have generated over $2 billion, yes, that's $2 billion with a B, in deposits for banks and credit unions nationwide. Throughout his career, he's worked with community banks and credit unions of all sizes and in all markets, keeping up with the industry shifts. And today we're going to discuss some of the themes we've been hearing about. And these include how to navigate a volatile and unpredictable economy, understanding and reacting to changing regulatory landscapes, and managing shifting customer expectations and digital demands. Today, we're going to break down how AI can help you grow net new household acquisitions and expand your share of wallet. And we'd love to hear from the audience as we go. So if you have questions, please drop them in the chat. We'll try to seamlessly weave them into the conversation. So welcome, James, and let's get into it.
Absolutely. Thank you for that awesome introduction.
You're welcome. So let's talk about what we like to call the industry landscape. There's a lot of noise out there right now about economic instability or stability, depending upon which way you look at it, and what's going to happen with regulation, whether that's the FDIC or the future of the CFPB. How is all this uncertainty impacting community banks and credit unions' approach growth?
Yeah, I think that, well, again, thank you for the introduction and for this fantastic question, because I think it's something that is probably in the back of the mind of a lot of executives right now in the banking world, because there is a lot of uncertainty around the guardrails and the guidance that they've received. And understanding what that's going to mean over the next 6 to 12 months is probably crucially important. I think a lot of them are kind of putting their heads in the sand and waiting to see what happens. Will they still have to comply with the same kind of regulations that have dictated how you can advertise, how you can share a rate in a marketing piece? Are all those things going to be softened? Are they going to make it easier by removing some of these regulations? And then that comes part and parcel with what is the policy of the Federal Reserve and how are they going to move, migrate, change, whatever they're going to do with interest rates. So I think all of those things and all of that sort of, rather than uncertainty, I think we look at it as like volatility, because it is swinging in different directions at all times. I think that the way that community institutions can benefit from that is to be out in front of it and make sure that their policies and the way that they approach consumers are in line with whatever regulations they've been under. Like, stay consistent there. Don't make any major shifts in how you approach, talk to, or disclose to people. And kind of wait and see and educate the community as you go. The kind of volatility that bankers are seeing is part and parcel with some of the uncertainty and volatility that consumers are seeing. So making it part of the conversation is probably a good thing. It's an opportunity for you to discuss these things with people and create a valuable conversation with them that will just cement you in their mind as their primary source for financial information.
Right. And with these fluctuations in interest rates, in the way we can talk about how consumers are charged, what should institutions be thinking about when it comes to their deposit and loan growth strategies?
Yeah, so loans and deposits, the two sides of the balance sheet, that is, the most important thing for any community institution, to making sure that they're feeding both sides. And with loans, it's been very difficult, obviously, over the last 2 years or so, as the Fed has kind of aggressively raised rates, which has impacted everything from fixed asset mortgages to car loans to all the things that people want financing for. And conversely, on the other side with deposits, there was a tremendous cash inflow that came out of the pandemic, which drove up deposit balances for consumers. And a lot of people have kind of been holding on to that capital. So strictly looking at the razor thin margin between your loan and deposit portfolio is short-sighted and I think excludes a lot of opportunity. And what they should be more focused on is acquiring household relationships that can have a long-term impact in either the deposit side or the transaction side for their institution. That, to me, is the key to long-term health and growth, is to focus more on the strategy that is about acquiring a household and getting as much of their wallet as you can at your financial institution.
Yeah, and I think looking at acquisition in terms of how household growth isn't necessarily a new concept, but what is new to bankers, especially small community banks and credit unions, is how to navigate the new world of AI and digital strategies when it comes to still wanting to acquire larger share of wallets and more householding in general. So how did these new digital strategies and AI play into that?
Yeah, so that's a great question. I think a prevalence of AI culturally over the last year has been very divisive. People either embrace it or they're terrified of it.
Right.
That's across the spectrum. So I imagine that in the banking world, there's a lot of people that are feeling the same way. And I'm sure in boardrooms, there are, splits on the C team, even between people who want to embrace it and people who think that it is potentially detrimental to the industry. So we have for a long time as an agency embraced it. So we felt like AI was a way to supplement our existing offerings, and it helped us find ways to better ideate for our customers in the marketing space. It helped us to develop better content because we almost looked at it like as an additional writer to help outline things and structure things and come up with ideas, and then our team would extrapolate on those and put our current stamp on them. And I think in the banking world, there's a couple of different ways that AI can be embraced. There is certainly a way to talk to consumers that hasn't been uncovered in the right way yet, to explain to them why these financial products are important. And AI can help you find new vectors of approach there to try to understand what's the right way to talk about a checking account, which can be not super exciting. But there are ways to do it that engage people if you can talk to them at an emotional level. And iterating with AI can help you get to some of those key phrases that will really move people. And that, I think, is one way that on the creative side, you can use AI to grow your community institution. On the analytics and data side, it's almost unbelievable the amount of enhancement you can do using AI in your approach. AI is free of a lot of the bias that a lot of humans carry. And because of that, it will find new and interesting ways to understand what a household looks like, what things are important to that household based on specific data points. And I think is a better indicator of those key needs, attitudes, behaviors, the things that we as marketers look for. AI can probably add another point of view where it looks at the data set that you want to mine for information on your customer and give you a couple of things that you weren't thinking about. And in marketing, we're looking for these tiny slivers of advantage, these tiny ways we can move and create incremental value. And I think AI is, especially on the analytics side, is something that a lot of people need to be leveraging more to get closer to delivering for customers.
So we shouldn't be scared of AI yet, is what you're telling us.
All I can tell you is I'm super polite to it every time we interact. I say hello, good morning. I say thank you because who knows? One day, you never know. You just never know. It's always good to just be nice, right?
That's right. So yeah, that's a really interesting perspective on how to utilize AI, how to get the most out of it. And its current iteration. We know AI will be changing, and AI will be changing the marketplace for everyone. But do you think now is a good time for bankers to be leaning on digital strategies to try to acquire new households or to try to go deeper in terms of share of wallet?
Yeah, absolutely. I think there's a desire, especially from the millennials that are kind of maturing into their more sophisticated financial services products. And even as we see Gen Zers acquire kind of those entry products that get them in, whether it's their first car loan or their first teen checking account or student checking, there is an opportunity to meet them where they most want to perform financial services. And this is, I think, been the last 10 years or so have been banks, especially community banks and credit unions, have slowly realized, yes, I need to invest in digital relationships and digital channel distribution. The pandemic put that in overdrive. And really, in the last 5 years, a lot of them have refined how they do it. And if they weren't doing it before the pandemic, they're all doing it now. They're all delivering their online banking or mobile banking in a way that is consistent with a lot of the experiences that these generations have on their devices, right? The way they want to consume products. So that has become a must-have. And we, in fact, in our when we develop strategies for banks and credit unions, we try to encourage them to look at their online and mobile banking as a branch, almost P&L it like a branch. It should be, if not your highest performing, one of your highest performing branches. And what that does is allows everyone in the organization to see and understand that this is a viable, necessary channel where investing in it yields returns.
Sure. And we laugh about it here. It's kind of an inside joke about how if we know someone's a millennial, don't call them, text them. They almost get offended by a phone call. So it's very important these days to understand the different ways in which people like to be communicated to and ways in which they like to transact business. So in the past, you expected that your customer will walk in the door. But these days, as the boomers age and millennials and Gen Zs become more and more part of your customer base, you really have to think about meeting them where they are.
Absolutely.
Yeah. So with that could be a growing concern among small community banks who've really relied, if you're in a rural area, you've really relied on knowing your customer and meeting them face to face. So that can be, a big concern for people. How do we engage the customer if they don't come into the branch anymore, and if you don't see them face to face?
Yeah, so that certainly can be difficult, and there are, I think, ways that some community institutions have found. Whether it's through the more traditional things that we've seen, like where you sponsor community events and you get your name out there and you have your people out where the customers are, that certainly is one way. But having a robust digital delivery of your services is the critical connector there. So this is, I think, probably more focused on their existing customer base, but if you don't have it set up so that you can very easily allow a customer to expand the relationship with you through 5 to 7 clicks on a mobile device, you are missing out on opportunities. And there's other ways that banks can distribute, and credit unions do a great job of this, where they basically are inside community institutions that need their lending products. And so they're basically on the other side of the desk from a consumer or a possible member who's going for a car loan or for a home, if they're doing a home improvement project and they're talking to a guy who's already got the services he needs to fund it from local institution that he could present to a potential client. Like there's lots of other ways that they can get their products distributed into the community. And I really do think credit unions differentiate in that space better than community banks. But, community banks have their own angle, especially on the commercial side. So,
right. So when you're out there and you're visiting community banks, credit unions, you're talking to people in the industry at conferences, what are their biggest concerns about the future of household acquisition in this kind of changing market?
I think it's that they have a hard time competing in markets that, because of this digital delivery is so prevalent, they have a hard time competing with major national brands that have infiltrated their market,
right,
and can seamlessly deliver, oftentimes with a branch that is, it may be a little bit snazzier than what they have because they could come in with some extra capital, build a branch as a foothold in a market, and then deliver seamlessly through their incredibly multi-million-dollar digital platform. So it is very difficult for community banks to compete with, you're thinking the top five, the ones that pop into your head right now, the JP Morgan Chase and Citibank, Bank of America, the ones that have retail branch networks throughout the country.
Right.
So what community banks do offer that's different from them is the opportunity to act local and invest locally. And I don't know that they always do a good job of explaining that. There seems to be, there were a couple of years ago, there was a sort of almost a shame at the size that they had and the constraints that they had as a community institution. And community banks didn't always feel like bragging about it. And now I've seen that migrate into this whole idea of local decisions and keeping your wealth and your money local. Like that is the angle they need to work, especially when you look at the way that certainly millennials and I assume Gen Zs are going to be kind of the same way, where they want to keep it local and they want to work with a small business in town. They want to go somebody, who maybe lives on their, in their subdivision or on their block that owns a business, and they want to support them. The community banks are no different, and credit unions to a certain degree, I think, have a little bit more community investment just because of the way they're structured. But community banks could absolutely leverage that angle more and lean into the idea that, small business Saturday, right? Community banks are small businesses. They love to think of themselves as a little bit above that, but that's the reality. They're a community institution. They're a small business, small to medium-sized business in the community.
So if, we're seeing this happen in our own market right here in Franklin, Tennessee, where we've become definitely a target for the bigger banks to come, and they will set up shop overnight practically with a new, branch location. And they look very, modern and super high tech in comparison to kind of some of the historic buildings that we have around here. So I definitely know this is happening probably in other markets around the country. It's hard for the community banks to compete when it comes to marketing spend. They're never going to have the dollars, and they're never going to necessarily have a competitive offer that they can put out there to compete locally with these big banks. So what do? How do they compete?
Well, I think when on the acquisition side, so you're talking about acquiring new households, right? Yeah. So that part of it can be difficult because you're up against a national marketing budget that includes ads during the Super Bowl. Okay. How do I compete with that, right? Well, the way you compete with it is, especially on the acquisition side, if you're looking for new households, is to, and this is going to sound cliche, but just be smarter about how you spend your marketing dollars. So we've spent the last year and a half or so developing an approach and a product that we call T3, which is our acquisition tool for community banks and credit unions, which basically does a lot of the heavy lifting there. And at its core, T3 is structured around two major components. creative that lifts up your existing brand and offers and presents them in a beautiful way, both digitally and in the mailbox. So in the inbox and in the mailbox.
Okay.
And then on the other side of it, you have your existing customer base. What we do is we take that list, we look at it, we create a predictive model, and we try to understand what your market looks like for new households that you can acquire.
Right.
And then we overlay 4 very specific segments that will align with a product offer. And what we're doing is, instead of if you think about the most, broadcast media or even some print media, it's a bit of a shotgun blast, like you're hoping you hit the right people. And this is taking the work up front to kind of understand your existing customer base, who's most profitable, who's most likely to open an additional product that you have to offer, and then finding lookalikes in your market that you can hit them with a digital offer that'll come in through a myriad of paid digital platforms that we work with, hits them with a direct mail piece in their mailbox that is kind of echoing that digital offer they already saw, and then follows up with another digital offer at a specific time interval. And what do those things do is they create that kind of idea, hopefully, in their head that this is the right institution, the right way to go. And because we've targeted to these specific households based on all kinds of factors, the household construction, the home ownership, the types of loans they might have already, the general liquidity indicators that we can look at, credit scores. There's a whole myriad of things that you can look at to try and decide, is this a good target for your institution? And we've gone through a lot of the work to build that model so that it is completely turnkey for our clients. So they come to us and they say, we want to do this. We want to advertise in a more intelligent and targeted manner. And we basically develop this program to make it easy to go, from we want to do this to execution. It's about 30 to 60 days, depending how slow your executive team is. And we launch the program, have it in market, and start, collecting results and hopefully deposits, within the first reporting window, which is typically 8 weeks from the first drop. So, yeah, it's an aggressive program that we've seen work before. You mentioned at the beginning the $2 billion in deposits. I was able to successfully execute a very similar program at another place where we basically were able to move $2 billion in deposits to our clients' accounts that were either existing or created with our help. And it's a great way, I think, for community banks to leverage the intelligence, again, back to the original topic, the intelligence of AI and the thoughtfulness that it brings to the creative process. All of that stuff is integrated into this program.
So it really makes it sound like you're taking a very sophisticated, targeted marketing approach and making it accessible to the smaller banks that may not have the internal capability of putting a program like this together. But let's say I'm a mid-sized bank. Is this something I could pull off on my own?
It requires substantial investment from the institution. You've got to hire staff to digest and understand your data. And you've got to make sure that if you don't already have a marketing team and a product marketing team in-house, that you're figuring out who can do that stuff. So I think it's because their main reason for living is not necessarily to have these departments in-house, right? Community banks are there to serve their communities, even these larger mid-sized ones. It can be difficult for them to invest in the infrastructure required to do this kind of stuff. And because we built it to be as easy as possible for them to engage with and implement, to me, it would be, it would be very difficult to build out the infrastructure inside a community.
Okay. But as a third-party provider, is there a security concern with passing customer data on to a company like ours, or how does that work?
Oh, absolutely. I think that's, in fact, when we engineered this, one of the first things we did was talk to a data partner that's not just a partner on the analytics side, but also is somebody that we know can handle large volumes of data that sometimes comes in disparate pieces and has to be kind of connected. We know that they can look at a list of customers and understand how those households work within a customer database, and also product construction, how to match it to a product table so that they can tell who's got what and what kind of score they should get as an existing household.
Okay.
Not to mention all the other pieces that come along with a program like this, like figuring out distance to branch, which is an important part of any sort of predictive model in a market. Aside from all those things that are kind of the intellectual side of analytics, they also have a SOX 3 compliant, highly vetted security platform for receiving data. So we do hear that a lot from community banks, like, we want to have you fill out our security questionnaire. Luckily, most of them, it's only 1 to 2 pages. Our strategic partner that handles the data is well equipped to handle that and has served some large financial and insurance institutions over the last 20 years and has built that infrastructure that allows them to be that partner for us. I mean, it would be difficult to do it without somebody who could handle the data in a safe way, considering all the regs that are around that right now. But then again, who knows, that might change in the next 6 months.
Well, let's talk a little bit more about data since we're on the subject. A lot of banks come to us and feel like their data is messy or incomplete. How does a program like this help institutions keep it, clean it up and actually make it useful for acquisition and cross-sell strategies?
Yeah, one of the things that we do when we build these campaigns is we take their data and we clean it up and get it to a place where we can use it for both cross-sell, because that is a big part of the program, and then the predictive modeling for the households in market. And through that process, we find out things from these institutions, like, do you have a good way of householding accounts? Sometimes they're like, yeah, totally. And then sometimes they're like, we don't know what you mean. So we have to kind of walk them through that process of creating match keys and understanding how you group a household, which for community banks can be difficult because of the way the commercial side typically works. So it's important that everybody's on the same page with that methodology, and that whole process of going through that oftentimes elevates the value of the data inside the institution. So we like to call that like the side effects of the T3 program. Like, there's a whole front end that involves some competitive analysis and some understanding of your market and your offers. But then there's also when we dig into your data and we start to see things that you could do maybe to help for future campaigns or just future growth of the institution. And so the cleaning it up, that whole data hygiene stage, that's one thing. On the other side, a program like this works great with digital and direct marketing outreach, but it works really well when you can integrate it into your branch operations. So if you can, at the very least, take whatever offers we're putting out to market and make sure the ones that resonate with the people who typically come into a branch are hanging in the branch when they come in, there's that synergy. That's great. Further, if we can return a file to you that tells you what offer everybody got to make the interaction at the front line, the teller interaction, that much smarter, they'll know, they get a pop-up, however your system works. They can get an indication that this offer has been made to this customer, and they will know how to approach that person based on the segment that they've been put in and the offer that they've been made. So on the front end, there's the hygiene and the cleanup that we can help with. We can help advise on that. That's typically up to the bank if they want to do those things. If they can accept additions to those customer records through their core system, if they have a good core or even a middleware that helps them at the front line, we can give them that data back just to better inform the whole process. And then, over time, as you do these campaigns, we typically recommend 3 campaigns a year. You start to build on that base of information that you have for both prospects and customers.
So it sounds very tailored in terms of the offer that the customer gets, and the way in which you deliver it. But how do we combine the tailored part with the targeted part? So, I know one of the pillars of T3 is that it's targeted. And we talked about AI earlier. How does this all come together to make sure we're talking to the right household with the right offer?
Yeah. So I think where the targeting comes into play is again, trying to figure out, based on these attributes that we've established and the most likely households in the market that would be attracted, because they are lookalikes to your existing customer base, would be attracted to your institution. We focus on creating that universe. And then we look at those people in that universe of prospective households and figure out, based on attributes at each of those households, which ones align with the offers. Now, you will see things like Axiom and Prism and all these other types of segmentation models that have endless amounts of segments, sometimes 15 to 20 different consumer segments. Those might be great for some industries. They're not great in channel deployment when you're trying to be efficient. So what we do is we narrow that down to these basically 4 specific segments for targeting that are aligned with the offers that we've all agreed on up front. So we know that the checking offer is going to go to this particular segment. We know that a high APY, savings product, the liquid savings product, will go to this segment. We know that certificates of deposit are particularly appealing to this other segment. And then we have another segment that we kind of call the sort of wild card in every market, where we maybe test a few of those offers.
Okay.
In that alignment is where you make sure that, targeting is one thing, but what are you putting in front of them? So it's aligning that tailored creative for that specific segment to make sure that they're getting the message that we think they're most likely to respond to.
Oh, yeah, that makes a lot of sense. So AI and this program, the T3 program, sounds like it can really help community banks, stick within a budget, but still accomplish their institutional goals for the year. But how is it overwhelming for the staff internally in terms of how they are going to fulfill against these offers?
No, I don't think so. I think that if so we don't go in and ask them to, for instance, completely revamp their product lineup. Or we don't go in and say, your brand is terrible and this needs to change before you can do anything. We're interested in propping up the institution as it is. We can certainly advise if we have simple things that we think can help on the brand side or on the product development side. But we're not necessarily there to, recreate the institution. We're trying to support some things that have already worked in the past and strengthen those. So we spend time understanding them and figure out how you're competitive. If there's a glaring gap in the product set, we will make recommendations. But that can be a huge lift for a small community institution. Trying to put a new, checking product on your core system can be really overwhelming. And we get it. That's why we try to focus on what do you already have. The turnkey part of it is we want to make this as easy as possible for you to acquire new households and better monetize existing ones. So let's look at what you have. Let's figure out how do we present it and dress it up and make sure that the segments that we're approaching with these are the right ones. So you're not wasting money on people who don't care or aren't likely to move. And then you just focus on the right message at the right time for those people that we think are in the right phase to be attracted to your institution.
Yeah, it's true. The most effective marketing is marketing that is, timely, that the right message at the right time. So I'd love to hear more about, maybe a success story or some sort of case story or an anecdote that you have from the past working with community banks and credit unions in this way.
So I think when we ran a similar program, there were banks of all sizes and credit unions too of all sizes. So everything from 1 to 2 branches, maybe like a de novo, or maybe a 3-branch institution, all the way up to a multi-state. We called it super regional bank. They thought the program would be helpful for them because they were struggling with some of the other initiatives that they were trying to do internally. So it worked. The theory of this idea of having tailored creative that is targeted to people that are ready to hear it works. I mean, that's like marketing 101, right?
Timing is everything.
Right. But there is some intelligence behind it that I think sets this program apart. And a lot of that is how we look at the existing customer base to understand how can we find people that are like your most profitable customers. So we don't look at your customer base and try to figure out if everybody in a particular neighborhood, except for 5 guys, have an account with you. We don't care. What we care about is the relative profitability of all these households. And then we try to look at attributes outside of just geography or base demographics and try to understand, are there people that match that criteria in your market? And that type of program can work almost in any industry. I feel like the financial services industry has a bigger appetite for something like this because they are interested in understanding those motivations that drive people. And they also, I think, frankly, have products with better margins than some other industries, where if it's a razor thin margin, it can be difficult to use an approach like this. But financial services, I think, are ripe for a program like this, where the targeting and the custom creative really make a difference. And we saw that we had one particular institution that was in the Northeast, and they did the program for probably about 2 years. And over time, it not only changed the types of customers that they were acquiring, because they became more focused on that idea that I want the most profitable, not necessarily the most biggest balances. Like there's things you need to look for to help understand how customers impact your institution. So they were more focused on the profit levers at the product level. And over time, it really evolved their entire customer base to the point that as we continued the program, it became obvious that there was going to need to be some radical changes in the approach and the products to try to get more people in that net. And we were able to shepherd them through that whole process of both developing that first iteration of the model that did a pretty good job of detecting people that were likely to open. And then as we slowly grew into that program, not only were we able to find more people in market to start relationships with this institution, but on the look back, you do like an 18-month look back to see how some of these accounts have matured, and the existing customer base share of wallet had expanded so much that I think it shocked everybody at the institution. So we went through and we look at all those things to try to understand, first of all, is it moving new people to join your institution? Sure was. And then is it also doing that secondary effort, which in the beginning can carry a lot of the economics of a campaign like this? Are you getting more share of wallet from your existing customers? Are you using this predictive modeling about your base to understand what's their next likely offer?
That's great. And speaking of offers, what if a bank doesn't have a strong offer to begin with?
Yeah, we like to think that the targeting does a lot of the heavy lifting on that. But the side effects of the program, that first 30 days where we do that competitive analysis, if there's a huge chasm between your product and the next, worst product,
right?
that usually is a cause for conversation, at least like, let's figure out what can we do. We typically don't think it's good to throw like a spiff or something that can get a short-term client to come over. The free checking days, the free offer, free this, throw cash at it. That stuff can work in some situations, but the only time we will recommend using something like that is if your product is so outdated that we don't think it has a chance to break through. And getting core checking is really the key, right? I mean, the vast majority of the offers that we're going to want to send out are going to be trying to acquire the primary checking account in a household. If you have any competitive feature buried in there, we will dig it out. We typically go through all of everything we can find, the opening kit, the terms and conditions. There's always some little nugget of something you can find that can differentiate you from the competition and market. So yes, it does happen that there are things that are almost, accounts that are like, it's not going to work, but there's ways around that. And the targeting solves a lot of that, but also I think there's opportunity to find maybe nuggets.
So you mentioned something in your explanation, well, you hit on something there, which is core deposits. And core deposits are something that every financial institution is striving for. So how do you think it moves the needle in terms of core deposits?
So I think that it is a powerful way to find the households that have the liquidity to contribute to that for the institution. And they also have indicators that tell us that they're high transactional, which is another part of how I think institutions find these valuable, is that we're trying to target people that are going to open a checking account and make it their primary payment function. And how do we do that in the messaging? How do we encourage them to do that? That's one part of it. But I think focusing on the relationship side and all that the institution can bring can really strengthen the consumer's desire to want to use them as their top of wallet, right? That's the number one card you go for.
Right.
Some of that goes back to technology too. You have to be able to do things that'll make it easy for them. Can they tap to pay? Can they pay on their phone? Like there's a whole host of other sort of pseudo fintech products that need to be considered in that relationship. But if you're giving them ease of use and a great product and incredible service, whether it's on the digital branch or in branch, I think you have the opportunity to really get all the value out of that household relationship that you can.
Great. And, we've talked a lot about household acquisition today, but how does T3 support banks and credit unions in cross-selling and deepening those relationships over time, not just at the initial offer?
Yeah, so I think that's where the full power of the program really can come into play, is if you're taking the offers that we're making to these households with every drop and putting the propensity ranking and the scoring into your CRM, whatever system you're using, whether it's your core system or if there's some other middleware that you have that the tellers use, that can not only help you better serve them when they show up at those service points, but it also gives you the opportunity to look back 12, 18 months after a campaign and try to see how has that household matured. And we used to do a lot of vintage analysis to kind of see how did these people contribute, not just to the deposit side of the balance sheet, which is what we were there for, but also did this grow into a loan relationship? Mm-hmm. Did this household that we established through the program also have a small business account with another institution that you convince them to move to your community bank? I mean, those are like those wins when you get the full picture of loans, deposits, and commercial, obviously. I mean, that is like, whoa. And we've seen that happen with the program. But a lot of that is back on the institution. Once we've done the job of getting these people in the door, it's really having good systems and good processes in place to make sure that you are able to serve, fulfill, and hopefully grow those relationships.
And the turnkey part of this is very attractive, I know, for banks that and credit unions that don't have large in-house staff or don't have external partners that they're working with. But in addition to this program, I know that there's a lot of responsibility put on the marketing employees to get tons of content put out consistently. So can a program help with something like that?
The T3 program, probably not as much, but as an agency, I mean, we have lots of solutions for that space. And being that our history is in financial services, I think we come to that with a unique perspective that a lot of other agencies don't have, which is this idea that not only have we been in the front line of a financial institution, but we have seen the things that move the needle in the boardroom, in the C-suite, that get people excited about marketing programs and contribute real profit and value to the institution. So we have a kind of a content engine here that we run for clients across all different industries. But I feel like our experience in financial services sometimes, skews our approach, because we do like that. I feel like we like that industry and understand it a little more deeply, I think, than some other industries.
So I think I've got a couple questions here that have kind of come in along the way. So somebody asked about barriers in getting a program like this up and running. Is there anything special that we need from them in terms of their website or their CRM in order to help this program work? Good question.
Yeah, so I think that the turnkey nature of it is engineered to take as much burden off of staff as possible. And usually the first question we ask is, does your website represent your brand? Because if it does, that makes it easy for our team to develop the collateral around. If you're going to tell me, no, the in-branch experience is completely different and it's got a different logo, we may have a little bit more that we need from you. But if we can get some of these outside things to help us start building, that's an easy way to get started. The data side is usually what's most daunting for people.
Right.
So typically what I'll do is explain to them or ask, like we have a discovery process where we're like, is there a vendor that you're working with today that you send a full copy of your entire customer base to on a monthly basis? 90% of the time they'll be like, oh yeah, totally. There's this program that we've been doing for 10 years that we always send them a copy of the customer base, whatever it is. So we say, okay, great. That same process, that's what we're going to need, a copy of that file, but we just need to make sure that these other attributes are on there. And we don't always need the deep PII. We need like the name of or we don't need the name of the account holder. We do need the street address. We need the zip code. And then we need to know what product they're in, what their current balance is, and anything else that can help us understand the existing relationship. Like, are they in some kind of loyalty debit card, whatever it is, any kind of program that's making them stickier. And typically they're pushing a lot of that data to another vendor for some program or product already. So we're not always asking them to start from scratch. It's just something you find out during the discovery period. If you can repurpose that for us, that will get things moving much faster. And then over time, we ask for, things that can maybe strengthen the model. If there's more information you can give us, we'll always take it. But yeah, we try to make it as easy as possible to get the program off the ground.
And that was another question that we have coming in. You said, does it take 30 to 60 days to get the program launched? And how many drops do you make throughout the year? I'm guessing they're talking about direct mail, but I know there's also a digital portion to this program.
There is. So the 30 to 60 days is me being optimistic and probably overly aggressive, but we have launched in 30 days before from signing the contract to being in market. But it was a much more refined brand, and that whole data transaction part, they had that locked down, so we were able to get data files quickly. 60 days is probably a little bit more reasonable for a first-time client. And what happens typically is we recommend that you're doing at least 3 drops during the year using this program. And each of those includes what we call kind of the front-end digital softening, where we're doing some paid digital campaigns that reflect the offers and the analytics. And then there's a inbox campaign, a mailbox campaign, and followed by a little bit more digital advertising, just to kind of seed the ground and make sure that the message is getting out there. And then we typically have an 8 to 10 week measurement period, depending on the size of your market. And then you wait another 4 to 6 weeks and run the program again. And typically that cadence gets you about 3 drops a year. We don't always recommend this sort of program in Q4, but it could certainly work in the early part of the quarter, just because consumers are typically very distracted in the last quarter of the year. But there's still value in some of this, getting the targeted message out. But yeah, that's typically how the program works and what we recommend.
Okay, great. I know we're coming up on time here pretty quickly. So I'm going to get this wrapped up, but I know that there's another webinar coming up next month where we are going to take a deeper dive into the data and analytics portion of this whole program, where we can also open it up to the audience to ask questions when it comes to their core provider, the technology stack that they're dealing with, and then what the security behind the transference of customer information and how that works with this program. But in the meantime, I wanted to thank you very much for attending the webinar today, everyone, and for joining us on this very important topic of AI, digital strategies, and customer acquisition. So we hope to see you next month, and check your email inboxes for your invitation coming out very shortly. And James, anything you want to close with today?
No, thanks. Thanks for letting me talk at you for the last hour.
No problem.
You're dear to my heart.
All right. Thanks, everyone.
Thank you.
Bye-bye.